Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is another in my continuing series on YouTube subscriber requests for me to analyze companies that subscribers are interested in. And I kind of like the opportunity. I'm going to look at Unum here, the life and health insurance company. Now what's interesting to me about this is I don't really follow this company and I've not done extensive research. One of the real advantages of the FastGraph research tool is in determining whether a stock is really worthy of researching it or not. And I do that by running the company through some basic analysis. I'm looking at valuation. Is the stock reasonably valued relative to historical norms? Does it have the growth characteristics and the dividend characteristics, if it's a dividend paying stock as this is, that I'm interested in owning? So one of the first best benefits of using FastGraphs is to figure out, is the company worthy of conducting a more comprehensive research and due diligence effort? So let's kind of take Unum apart here a little bit and look at a couple of things that strike me immediately. Number one is there was a lot of cyclicality in this stock. This is going back to the recession of 2001. We had a big drop in earnings in 2003, but since this time, if you notice, the growth rate went from 3.6%, but since 2006, let's take it back one more year, since 2005, the company's actually grown operating earnings at about 8% a year. And their dividend record during this period of time has been really attractive. Their payout ratio is very low, which means they aren't paying out a high percentage of their profits. The area below the white line is the dividend payout ratio, but let's look at it in numbers. The company has kept their dividend flat from 2005 through 2008, and then they started growing the dividend since 2008. And over this particular time frame, since the beginning of 05 or the end of 04, the company's averaged about 8.8% dividend growth, compound average growth rate 8.7. Now what's interesting about this company is that, having said that, it is not an above average performer. The company has produced similar dividend yield than the S&P over this time frame. It's moderately underperformed the S&P on a capital appreciation basis and moderately underperformed it on a total return basis. But you would call this probably pretty close to being a good average company. So that's a plus. But keep in mind, this calculation that I'm drawing here is drawn when the stock was trading at something pretty close to its normal, I'll say 9 to 10 normal PE ratio. And that's the second thing that strikes me. Over all the time frames I've been looking at here, I want you to notice that the market has a tendency to value this at only something around 10 times earnings. So it rarely ever trades at the multiple of 15 times earnings that most stocks with an 8% growth rate would actually trade at. Now it's BBB rated, only has 21% debt, and I consider that a plus. The real key is right now it appears to be trading relative to historical norms at a very low valuation, a blended PE of 8.1, offers a 2.7% dividend yield, and with some potential to make some capital appreciation as well as some dividend income. Now if I just do a quick calculation of capital appreciation potential here, total return, if the stock were to go back to its 10 PE, and if it did earn the 19.6 and 6% growth rates that analysts are expecting over these next couple of years on earnings, you could get a very nice rate of return, a total growth of about 47%. You could pick up some nice dividend income and have an annualized rate of return of about 19% per annum out to 2020. So from a valuation point of view, this stock would be worthy of researching it deeper, at least in my opinion, as I look at this. Now, one of the other subscriber requests that I've had is people have asked me to look at the earnings yield table, and I rarely talk about it in my video. So I'm going to go down to the earnings yield estimates and talk a little bit about what this particular graph is doing. There are things I really like about this graph, and frankly things I don't. For one thing, it's pretty aggressive. We simply take estimated earnings growth rate, whatever that number is, and let's look at that forecast right now. The 3 to 5 year long-term estimated growth rate, which is only one analyst, is 9% going forward over the next 3 to 5 years. So given that, when I go to the earnings yield, I'm using that as just simply a basic growth assumption. That's pretty aggressive and pretty strong, and it's a pretty long period of time. 10 years is too long to be forecasting this growth, but what I'm really trying to do with this is compare if it did. It's a what if question. What if it did grow at that rate? How does the company compare to a riskless investment like a 10-year treasury bond? Well, number one is, you'll notice this column is pink here. It's yielding less than a treasury bond is right now. But over the next 3 years, you would actually, assuming these assumptions, these growth assumptions were correct, you'd actually earn more dividend income than the Treasury would pay you in riskless interest. That's why the column is pink, and then it turns blue for those years. Now, from a total income point of view, if, again, this growth was there, and remember, this is virtually assured. If you buy a 10-year Treasury bond, you're virtually guaranteed to get these numbers. There's some risk in this, but you could pick up $3,800 plus in dividends versus only $2,800 in the 10-year Treasury bond. But the earnings yield is the primary focus here. And the earnings yield is simply the inverse of the PE ratio. Instead of price divided by earnings, it's earnings divided by price. And my personal minimum threshold is about 6 to 7% earnings yield. If a company offered me less earnings yield than that, then I consider it too risky for me from a valuation point of view. But in this case, you've got almost double that number. So from the earnings yield point of view, the company is very attractive. And again, this is a very aggressive assumption. If it were to grow by 9%, it would generate 6.7 times more earnings than the S&P would throw off riskless interest, which means you would be compensated potentially very well for the risk you would take buying a stock versus investing in a Treasury bond. Now, I want to look at a couple other aspects of this stock. Since it is a dividend payer, let's look at operating cash flow. Now, before I do that, I'm going to go ahead and take price off of the graph, because the idea here when I'm looking at operating cash flow, I rarely use it. I do use it in some cases as a valuation metric, but for dividend stocks, I primarily utilize it as is the dividend well covered by cash flow. And you can see the company generates significantly more operating cash flow than they're paying in dividends. In some cases, it's like in 2012, it was virtually 10 to 1. Now, all this means is there's no one making an estimate for operating cash flow going into 2018. That's all that means. There's no data to fill in that box. Now I'm going to go next to free cash flow, which is another form or method of valuing the company's safety of its dividend. Free cash flow is more than adequately covering the dividend again, which means the company should have no problem, given the amount of cash flows it generates, free and operating, to continue to pay and perhaps grow their dividend over time, especially if these analyst forecasts are right. Now, from a valuation perspective, EBITDA, or earnings before interest, taxes, depreciation, and amortization, is a good way to value most stocks. Again, I have no forecast here, but watch how price correlates to these changes in EBITDA in this particular company. You can see the price going up when EBITDA was rising here. You can see the price dropped. And then as EBITDA recovered, we had a nice rise in price. Then we had, again, another period of negative EBITDA growth coming into the Great Recession, as almost every stock did. The market might have, overextended the downside here. Then we had some EBITDA recoveries. Then we had drop in EBITDA. I just want you to see this, that the company does seem to be valued very consistently relative to the amount of EBITDA that the company generates. And its normal multiple is about 6.7 times EBITDA. That would be the multiple of this orange line. The company's currently trading at 5.2 EBITDA, but there's an asterisk there because there's really no forecast. Now next, I'd like to go ahead and move into forecasting, because you can always examine the past, but you can't really purchase the past. You can only purchase the future. So looking at this company from a forecasting point of view, and remember that the market generally prices it based on its normal multiple. I picked the 9-year normal PE ratio of 9. I've got the option to evaluate how the market's valued the stock. Now, in the 5, 4, 3, 2-year, 1-year time frames, it's actually been given a double-digit multiple, but typically it trades somewhere between 9 and 10 times earnings, as I suggested earlier. So I'm using the conservative case here of 9. If it were to at this 9 PE and generate this earnings growth, you can see the total rate of return through the end of the year would be over 21%. It's annualized at 52, but it's obviously less than a year. If I extend that out further and go out to the end of 2018, you can see we have a capital gain potential of about 27%. We have some decent dividend income over that time frame, so we'd average a total return of 31.37%, or an annualized rate of return of 20.56. And then if I go out a little bit further, we still stay at double-digit rates of return. So using this moderately conservative normal PE, the company offers decent potential. If I go ahead and push that up to something even more normal, like 9.6, these numbers even get a little better. I've got an 18% annualized return out to 2020. I've got a 25%, almost 26, annualized out to 2019, etc. Now, the company has little debt, and it does have forecast growth potential here, but the real key is, if you look at the company historically, is it going to be able to do that or not? So it's an interesting company that I would consider to be research worthy. Now, if that were the case, I would start by simply going into the company's website, and I've talked about this before. I would start looking for things like investor services. I would look for any presentations that the company has done, and I'd want to go ahead and review those presentations. And one reason I do this, by the way, is when I'm looking at these analyst estimates, I want you to be clear about something. Most of these analyst estimates are a function of going through and looking at the company's presentations when the company is giving guidance on what they think they can do. I can also go into several other sites. For example, I'm going to try Morningstar here to see if they offer anything comprehensive on this company. I happen to be a subscriber to Morningstar, but Morningstar is not providing a comprehensive analysis of this company. So that's not necessarily a negative, it just means it is what it is, so to speak. But then I can go into Seeking Alpha, for example, and as I go into here, I can find several articles. And I see here that the company began trading on the New York Stock Exchange apparently somewhere around June. That's something I wasn't aware of. And there are different articles. Is it time to take profits? Is it time to buy the insurer? I've also got instant access to news items here. And I can also go into this earnings tab here. And if the company produces a press report, I can read transcripts or look at the 8Ks and the 10Ks. And as I can here in the more recent quarter, they did miss by a penny, but they beat on revenue. That to me is not a miss, but some people call it a miss. And they were strung by long-term care, it says here, so the stock dropped 15%. Those things probably attribute to the fact that it was also relatively overvalued relative to historical norms when you look at this. So there's my take on Unum. From a standpoint of analyst scorecard, how accurate have the analysts been forecasting this company? It's got an excellent scorecard, which means either the company gives good guidance or the analysts find this company easy to analyze, which gives me more confidence in these forecasts than I might have if the scorecard wasn't as good. Anyway, this is Chuck Carnevale. This is a subscriber request series. I've never looked at this stock before. It would be one that I would probably personally consider going in and looking a little deeper if I was looking for good value with we'll call it a slightly above average market dividend yield with an excellent valuation. The company seems to have all that. If you found this video valuable, then I would suggest contacting us. You can contact us at www.fastgraphs.com by email, or you can call this number 813-960-9600, or email policy@fastgraphs.com, and she can help you learn more about Fast Graphs and how it might be able to help you with your investments. Thanks again for watching.